The traders are answering your questions. First up, for Steve Weiss from Nick in Seattle. As parts of the country reopen, what retail stocks are you looking into?
I think it's going to be a challenging environment going forward. And as I mentioned earlier in the show, a lot of people are still going to be out of work or worrying about being out of work. So I would stay to the two ends of the spectrum. I own Lulu. I own Agree Realty, which is really a retail play because it's got all the blue chip retailers here. So that's what I own. I'm not interested in buying department stores. I'm not interested in buying any other mall stores because they're going to limit capacity. And frankly, I'm just not adding to Lulu or anything here in retail. So I'd rather put my money elsewhere is really the bottom line.
All right. Dave in Texas asks, which one stock is a conservative buy in this volatile market? How about Jim? You take that one.
Sure. Thanks, Don. Hey, Dave, listen, I want to make sure we're defining terms. Conservative means not a lot of volatility, means it shouldn't go down too much, but it won't go up as much either. But in that context, take a look at Verizon, okay? 4.4% dividend yield. You're not going to see a lot of price movement. The fundamentals, though, support the name. A lot of wireless connectivity. Not everything is perfect. You got to wonder about the video feeds into residential homes, but that's a conservative play, Verizon.
All right. Shannon, a question for you here. Thoughts on Coca-Cola? Buy, hold, or sell? Currently have a 15% loss on position. Thanks.
Well, I sold Coke several months ago and actually swapped it with Pepsi. I think the upside for Coke, despite the fact that there is some upside because it's a consumer staple and those generally tend to hold up better in volatile times, there's been a lot of operational efficiencies that Coke has been able to deliver over the last couple of years. I think the opportunity is better in Pepsi. They still have some bottling efficiencies that they can squeeze out. They also have a distribution in the snack area, which I think diversifies their business a bit better. So that would be my pick here.
Brian in Brooklyn, New York writes in, when do you think is a good time to buy into the leisure and travel section of the market? Steve Weiss, maybe we'll throw that one to you.
Yeah, look, there are some positive trends going. For example, I think people will be more disposed to staying at brand name hotels than Airbnb because they'll trust that they're disinfecting it, keeping it cleaner, rather than an individual homeowner or somebody owns multiple apartments and renting them out. However, I'm not buying these until we have a vaccine. Now, what I did was I bought long-term calls, very cheap calls in United and Delta, so that hopefully we have a vaccine by then, but they're very cheap. The stocks have to double for me to be in the money. It's not going to wait till then. As we get more news, they'll trade up. But I just thought that was the least expensive way and the least risky way to play those stocks. Some of these can go bankrupt. I just don't want to be there if they do.
All right. Now, how about from Danny in Los Angeles? Is Qualcomm too expensive right now? Jim, you actually own QCOM.
Yeah, no, I don't think so at all. I mean, I think you're looking at normalized earnings returning to this name in 2021, easily $6 a share. You put a 16 times multiple on that, $96. That's a 20% return from here. Worst cases, that gets shifted to the right in terms of the time frame. Maybe it's mid-2021 to mid-2022. Still, that's a good return looking at this name.
All right. Now, how about from Dylan in New Jersey, the Garden State yet again? Can I please get your thoughts on Chubb? Shannon, you actually own this one.
I do. Thanks, Dylan. We think insurance is a great way to play the financial space right now. We do have some bank exposure, but it's limited to Liz's comments. Chubb is the leading property casualty insurer. They're best of breed in the space, great underwriting margins, and room to engage with a higher quality client base. So we like Chubb.
All right, and finally from Dan in North Dakota, I'm new to investing individual stocks and would like to get into the markets now. Is there a sector I should research now, or is it better to wait until the market is more stable? Liz, we'll throw this one to you. What do you think?
Dan, I want your first experience with these stocks to be a good one. So I would say let's run a drip campaign, drip in little by little. And as I said earlier in the show, demand for healthcare and IT should stay healthy regardless of recovery now, recovery later. So those are good places to start.
Yeah, I'm focused on the word trade here, and I just don't see any good trades at this level. In terms of long-term investment, just look at my holdings. De facto, I'm deciding every day whether I want to own it or not. So long-term buys, I'm comfortable with that. Trades, I'm just not going to do it today.
All right, Jim Lebenthal, to you. What do you think? What's your final trade?
So if you have more cash than I do and you want to put it to work, take a look at Kinder Morgan, okay? Here's a dividend play plus capital appreciation potential. Three numbers to think about. 2/3 of their business is natural gas, which is doing much better than crude oil. 90% of their business is take or pay or fee, meaning that it's not cancelable. And 3/4 of their clients are investment grade credit quality, so they're not going under. That dividend looks pretty safe at Kinder Morgan.
All right, Shenik Sakosha, to you.
Alibaba, emerging markets exposure and growing market.